If you don't have $1 million, you're locked out of the best investments in the world. That system is about to break. Everything you know about ownership is about to change. We are looking at a market shift that analysts at Boston Consulting Group estimate will be worth $16 trillion by 2030. This isn't just about crypto prices going up or down. This is about the modernization of everything else. It's called RWA, real-world assets. But to understand why this might be the biggest opportunity of the decade, we first have to look at why the current financial system is failing us. Right now, the global financial system runs on rails built in the 1970s. It is slow, it is expensive, and it is incredibly inefficient. Think about the best investments in the world: commercial real estate, private equity, fine art. These are the asset classes that build generational wealth, but they are gated behind a velvet rope. If you don't have a high net worth, or if you don't live in the right country, you aren't invited. And even if you are invited, these assets are illiquid. If you buy a building, you are stuck with it for years. Selling commercial real estate can take 6 to 12 months of paperwork, and brokers will eat up 5 to 10% of your sale in fees. It is a nightmare. This is where real-world assets come in. RWA is the bridge. It is the process of taking tangible, physical value and representing it as digital tokens on a blockchain. It sounds complex, but you've actually seen this before. Think about the gold standard. Once upon a time, paper money was just a token representing gold in a vault. RWA is the same concept, but upgraded for the digital age. We already have a proof of concept: stablecoins. Digital dollars like USDC are the first successful RWA. They are digital tokens backed by real cash in a bank. They move instantly, 24/7. Now imagine doing that for everything: houses, stocks, carbon credits, intellectual property. But this raises a massive question. If I buy a digital token, what stops the building owner from selling the physical building and running away with the money? How do we stop the fraud? That is exactly what we are going to cover in part 2. Make sure you subscribe before continuing. Alright, so how does this whole RWA thing actually work? How do we take something physical, like a building, and put it on the blockchain safely and legally? Let's go under the hood. Believe it or not, it all starts with the law, not with code. You can't just snap a picture of a house, mint it as an NFT, and call it a day. That's not a real asset. That's just a scam waiting to happen. To do this right, you need a really strong and dependable foundation that you can count on. In the real world, the first step is creating a legal entity, often called a special purpose vehicle, or SPV. Think of this SPV as a secure, legally recognized box. The physical asset, let's say our office building, is placed inside this box. This is crucial because it means that anyone who owns a piece of the SPV has a legitimate, legal claim to the building inside. It's what separates a real investment from a digital picture. This legal layer is also where compliance happens. We're talking about things like Know Your Customer or KYC checks. This isn't the Wild West of early crypto anymore. Reputable RWA platforms need to verify who is buying and selling these assets. This ensures everything is above board and complies with important regulations like anti-money laundering laws. It's all about building trust and security into the system from the very beginning. Okay, so once the asset is legally secured inside our SPV, we get to the fun part: tokenization. This is where the magic of fractionalization comes into play. In the old financial world, if you wanted to invest in a commercial building, you'd likely have to buy the whole thing. That could cost millions, locking out almost everyone. But with tokenization, we can digitally slice that building into thousands or even tens of thousands of little pieces. Each piece is a token. Suddenly, that multi-million-dollar building becomes accessible to a much wider audience. You could own a share of a luxury resort in the Maldives for just $50. You don't own the entire resort, of course, but you own a genuine, fractional piece of the equity. This opens up investment opportunities that were previously only available to the ultra-wealthy. But here's where it gets really revolutionary. These tokens aren't just static digital receipts collecting dust in your wallet. They are programmable, they are alive, governed by what we call smart contracts. Let's stick with our resort example. Say the resort has a profitable month from tourists. In the old world, a property manager would need to do a ton of paperwork. They'd have to calculate your specific share of the profits, probably write a check, and then physically mail it to you. The whole process is slow, expensive, and involves a lot of middlemen. With RWA and smart contracts, this entire process is automated. The smart contract is programmed to know that you hold, say, 50 tokens of the resort. When the resort's profits are recorded on the blockchain, the contract automatically calculates your share and streams that income directly into your digital wallet. There are no middlemen taking a cut, no administrative delays. It's a direct, efficient, and transparent flow of value. This is a complete game changer for how income from assets is distributed. And finally, we get to the killer feature: liquidity. Because these ownership stakes are represented as digital tokens, they can be traded on secondary markets. And these markets can operate 24/7. Think about selling a traditional real estate property. It can take months, sometimes even longer. You have to find a buyer, negotiate, deal with lawyers, and go through a mountain of paperwork. It's a slow and clunky process. Now imagine you own tokens representing a piece of that same property. If you need to sell, you don't have to wait for the perfect buyer for the whole building. You can go to a digital marketplace and sell your tokens on a Tuesday night at 3 in the morning, assuming there are buyers in the market. This ability to easily buy and sell your stake introduces a level of liquidity to traditionally illiquid assets like real estate that we've never seen before. So, we've seen that the technology works and the legal frameworks are adapting to make it all possible. The machine is built, but the big question is anyone actually using it? Are major players getting involved? Well, in part 3, we're going to look at the giants of finance and technology who are already building this future. You might be surprised to see who is already placing their bets on RWA. Make sure you stick around for that. Thanks for watching, and don't forget to subscribe for the next part. We've covered the broken system, and we've covered the mechanics. Now let's look at who is actually building this. For a long time, RWA was just a crypto dream. But the dream is over. The giants are here. Larry Fink, the CEO of BlackRock, the largest asset manager in the world, has said that the next generation of markets is tokenization. And this time, it's not just talk, it's live products, real money, and real settlement. BlackRock has already launched a tokenized money market fund, allowing investors to hold US dollar yields directly on-chain. Franklin Templeton has been running a tokenized US government fund on public blockchains for years. JPMorgan is using blockchain rails to tokenize deposits and settle real institutional trades through its Onyx platform. And here's the most important part. The biggest real-world asset on-chain today isn't real estate. It's government debt, US Treasury bills. Today, tokenized US Treasuries are the largest real-world asset category on public blockchains. Projects like Ondo Finance and Superstate are bringing US Treasury and bond exposure on-chain through regulated compliant structures, using blockchain rails to deliver government yields more efficiently. At the same time, infrastructure players like Coinbase are building custody and compliance systems specifically designed for tokenized real-world assets. These assets settle faster, more cheaply, and more transparently than traditional systems allow. Think about what this means globally. A startup founder in Africa or South America, living under high inflation, can now access US government yields through regulated on-chain products, not as speculation, but as financial infrastructure. Of course, this is still early. Regulation is catching up. Legal clarity varies by country. Smart contract risk is real. This is not a get-rich-quick scheme. It is a get-efficient-forever shift. But the trend is undeniable. We could be seeing finance's big internet moment. Just like email replaced the post office, tokenized assets are slowly replacing the old financial rails. For the first time, ownership itself is becoming digital, global, and programmable. The $16 trillion migration has already begun. The only question left is, are you going to watch it happen, or are you going to understand it before it becomes obvious? If you want to stay ahead of the curve on the future of finance, make sure to hit that subscribe button. Thanks for watching, and I'll see you in the next one.